Welcome to the HFR podcast. My name is Anika Akil, and I lead HFR Media. HFR is the established global leader in hedge fund data and analysis since 1992. To learn more, visit hfr.com. Welcome to the HFR podcast. Joining us today is Dr. Joe Brusuelas, an award-winning economist and member of the Wall Street Journal forecasting panel. Joe regularly briefs members of Congress and senior officials on economic issues, as well as appearing on all major news channels. He co-founded the award-winning Bloomberg Economics Brief during his time as senior economist at Bloomberg and was named one of 100 most influential economists in 2020 by Richtopia. He's currently chief economist at RSM, a consulting firm in Texas, where he has co-designed the RSM Middle Market Business Index. Joe, a very warm welcome to you on the HFR podcast.
Thank you for having me. It's sure good to talk to you today.
On the agenda today is central bank independence and the Fed's policy stance, as well as tariffs and their impact on inflation and businesses. We're going to kick it off with a discussion of the US dollar as reserve currency. So let's talk about the US dollar. We understand that if the policy is rate cut now or, Chairman Powell is fired, any of that will have an impact on asset prices, bond yields rise. And then we have the ongoing inflationary pressures, structural change because of tariffs. Does the sheer size of the U.S. economy allow it to withstand these incredibly negative pressures on the dollar as a reserve currency? Is there a contender you see as an alternate reserve currency? And what happens to the U.S. economy as the dollar's ability to denote value, serve as global numeraire, slips?
There is no alternative. Let me give you a good example before we get into a more substantial discussion. You know about the repo market, right? It goes unseen. It's the sleeping giant. The systemically important banks have to balance their books every night. The Fed recently estimated that the repo market's $11.1 trillion. The only way to balance those books is with a reserve asset and their dollar-denominated assets, U.S. Treasuries. It doesn't mean that if the U.S. engages in non-productive policy or just plain bad policy, that there won't be a diversification away from dollar-denominated assets to reduce the risks of holding those assets. That's happened before, right? Right now, dollar's about 60% of all currency reserves. That dropped below 50% in the 90s, but then it went back up because we've had this extraordinary period of American exceptionalism across financial markets, growth, and technological innovation. Now we might be entering a period of what I would call unorthodox public policy with the current president. That's going to cause many global investors to question the willingness of the United States to be the lender of last resort and be the consumer of last resort. That then augurs for a diversification strategy. But Anika, notice what I'm not saying. I'm not using the discourse of de-dollarization. That's simply not going to happen. The dollar's reserve currency status waxes and wanes, but it's still the ultimate safe haven. This global economy goes nowhere without the US dollar. I mean, I'm not a fan of tariffs. I'm a free trader. I like the free movement of people, capital, goods, right? Second quarter revenues from those tariffs increased by $47 billion. Want to know why? Because they have to pay it, right? And I'm no fan of tariffs, right? But that's happening. It's a real thing, right? So the dollar, it's going to depreciate. And it's likely to be we're in a multi-year cycle of depreciation. It's going to weaken against the euro. It's going to weaken against the pound, the yen, the major trading currencies, right? Through the first half of the year, it was down 14% against the euro. When deficits are back, we're right back to summer 2003, right? We've gone round trip almost in a quarter of a century. It's been a long time. Dollar's been a 14-year bull run, right? Like I said, elections matter. The policy preferences of the current administration are not aligned with globalization or orthodox macro or microeconomic policy. So this is gonna happen, right? It's one of the reasons why the price of gold, a barbarous relic, has increased. It's one of the reasons why we're seeing people flow into stable coins and crypto, right? Is there an alternative? No, not yet. Now, there may be a decade from now. We all see what's happening in Europe. Germans released the debt brake so that they can begin to reconstitute the defense of Europe, but also to rebuild their aging infrastructure. Should a European bond market evolve? Well, then there you go. I hate to tell you guys, Look at what the Europeans are doing. If you think the Chinese are going to provide the alternative to the dollar, you're wrong. It's going to be the Europeans. Just watch what happens as the U.S. pulls back, because it won't guarantee the security of the Europeans, both strategically or economically. Yeah, so you live in a very exciting time, and we're fortunate to see this. I like to call it the Full Employment Act for economists.
Yeah, I absolutely agree with you. And I also think that another reason I would concur that Europe is the place to be watching is because institutional strength matters a great deal to investors, institutional reliability. And I think certainly the paradigm that investors are used to trusting, let's put it that way, comes from, Western democratic institutions. There may be other strong institutions out there, but certainly the trust currently being placed by capital markets is on a certain type of institution, the likes of which you find in Europe and US. Yeah, please.
Put my chief economist hat back on when I was at Bloomberg, and where I only dealt with the big companies, right, and the banks. Real money institutional players won't engage in capital inflows or pure investment unless there's a predictability and a certainty. Right now, pervasive uncertainty is a very good description of the U.S. economy, and that's why you're seeing capital flows out of the country. I'm an economist. Trade deficits plus capital inflows always equals zero. The U.S. has the best thing going in the world. But this administration wants to focus on narrowing the trade deficit. That will result in less capital inflows, which means the dollar depreciates, right? And you get diversification out of dollar-denominated assets, which are U.S. treasuries. That results in a risk premium being applied as we see increased issuance, and that's going to cause interest cost on the U.S. debt to move well over $1 trillion, right? Again, these have real consequences. So you're spot on in terms of talking about certainty, real money players, and institutional investors.
So, Joe, our focus today will inevitably be around inflation, tariffs, interest rates. But I want to start with the importance of central bank independence and why that matters with something of a twist. We've been watching a face-off between President Trump and Chairman of the Fed, which has become a focal point of attention the world over. And recently, the winner of the European Central Bank's Young Economist Prize, Elena Wabish's paper, shows that the messenger matters in central bank policy communications. And policy communications make more of an impact depending on the popularity of who is making them, not just the fact that they are coming from the central bank per se. From the perspective of a forecaster, do you think that central bank independence is threatened not just by political attacks, but also by this catalyzed popularity context from social media channels that politicize its mission?
Well, time passes and things change. It's been over 40 years since we really moved to central banks and inflation targets. But central bank independence has been around, at least in the United States, since 1951. My sense is, though, that starting with the great financial crisis in 2007, the elevation of visibility and importance among central banks has altered the communications challenge for policymakers, and that the popularity of them does matter. The way in which Jay Powell conveys very sophisticated, very difficult material in a way that's accessible has altered the central banking landscape. Central bank independence has served both the American and global economies well. The long period of low inflation and low interest rates in part has to do with the credibility. One of the reasons why we had the V-shaped recovery coming out of the pandemic was because of central bank credibility. So the fact that we now have an American president who's only going to be temporary, attempting to jawbone the central bank to lower rates, is not out of line with historical standards. Lyndon Johnson and Richard Nixon both did that and didn't turn out well. We ended up having the Great Inflation, 1965 to 1985. And my sense is that Jay Powell and the central bank are not going to exceed the request. They're not going to cut rates. Sure, when Jay Powell goes and the president of the United States gets to appoint somebody else, the front end of the curve is likely to rally. But the Fed could also lose control at the long end of the curve. I mean, when I take a look at the U.S. economy, what I see is an extraordinarily appropriate interest rate given where the economy is and where the risks lie. And we'll get into that this morning. But I want to reiterate here, the central bank independence is a sine qua non of modern economic policy making. If you don't have that independence, if you don't have that credibility, you're turning interest rate determination over the medium to long term to the market in a way that will lead to volatility, lead to higher rates, lead to higher inflation expectations, and ultimately higher inflation.
One of the most recent press conferences that Jay Powell did, he reiterated again and again that the decision to wait on the policy rate changes is driven by the need to understand how tariffs will pass through to prices and to what extent they make their way to the end consumer. And he emphasized two things. He said the US economy right now is strong, and all forecasters agree on that, and that tariffs will cause higher inflation. And the subtext there is that the Fed would actually have to raise rates, obviously, if inflation picks up. So right now, it's holding off on doing anything to interest rates. Do you think it's correct to wait and see the extent of tariff pass-through on prices? And where do you expect to see interest rates going?
Okay, so I think right now the policy rate is extremely appropriate, modestly restrictive. I think that the risks around the outlook to an economy that looks as if it's slowing to around 1%, even amidst full employment and solid wage growth, is that we just don't know what the pass-through is going to look like from tariffs. With the June inflation data, you could see the inflation from tariffs beginning to show up exactly where you'd expect in everything that involves Chinese imports, toys, appliances, apparel, and audio and visual equipment, things like that, right? It was all there. It's easy to see. The two dogs that haven't barked, food and manufacturing goods, those are the North American supply chains, those are going to begin to show up. We've always thought that this was going to be a second half of the year phenomena. You know, Anikwa, when professionals like you and I talk, we can speak of long and variable lags on inflation. And it's beginning to show up about, as we would have expected, in the second half of the year. It'll be more pronounced in the October-November timeframe, which is about 6 months after the first tariffs started to be implemented, right? Okay. So we expect the policy variable the Fed used to set rates will move to at least 3% or higher. CPI will move to 3.5%. That is important. Inflation expectations, which have already moved higher, 5% over at the University of Michigan, a little less than 3% over at the New York Fed. We'll have to watch to see if those move. If they do, well, then we're going to have a persistent problem with inflation. If not, then it's a one-time increase. The Fed can look through it and then begin to think about cutting rates later in the year. Our estimation of the central bank's reaction function right now is the optimal interest rate should be set right around 4.65. All right, so that's right around the upper end of where the range is right now. The PCE variable is expected to increase from 2.3 to 2.6 in June. That will likely push the reaction function of the Fed, my model, higher. So then we're going to begin to think about, okay, we really need to be on pause for a little bit. In that same testimony you referenced, Jay Powell said the Fed uses 4 different models to estimate the optimal policy rate, and one of them was suggesting rate hikes. Well, right, as we see those tariffs feed through, well, that's going to become a little bit more prominent later this year. I did a back of the envelope to prepare to talk to you today and just put in my own Taylor rule. Yeah, it looks to me like the optimal rate is going to be pushed above 5% when we get that PCE data on July 30th, right? Now, we're not a black box forecasting team. All forecasts are a judgment, right? But my sense is, okay, we're now got a little bit of risk to the upside on inflation. Oh, and by the way, the expansionary fiscal policy that's about to be implemented, well, we got to begin taking that into account too, right? So while we think the terminal rate's right around 3 to 3.5%, I'm more comfortable with 3.5%. And like the Fed, I want to push rates down. But right now, the risks due to The large changes in both trade and fiscal policy require the Fed to be patient and on pause.
Absolutely. So I want to stick with this. Just one more question. Your firm produces the Middle Market Business Index. I wonder if you can provide insight, historical evidence on pass-through. How much do corporations pass on to consumers? And on balance, do the tariffs end up hurting middle to small businesses more or households more? Is it 50-50?
Well, let me give you a sense of, so the middle market essentially are firms that have revenues between 30 million and 8 billion, right? They often don't have the financial depth or breadth to absorb tariffs. Big companies like Walmart or Amazon, right? A tariff increase means, okay, they can negotiate because of their size, scale, breadth, and depth with the supplier to eat some, right? Then some of the tariffs, the rest are passed along the supply chain, thinner margins at the big companies, and then the remainder is passed through. Okay. In the second quarter Middle Market Business Index, over 60% of our survey participants told us that they're planning to pass along the cost. Now, that doesn't mean 100% of the tariffs. It means 100% of the tariffs that they're having to deal with, right? Which is why we're going to move above 3 to 3.5% in terms of overall inflation. They just simply, not only do they not have the depth or breadth, they can't go tap the Fed funds window, right? They don't have access in many cases to credit the way the big firms do, right? And too often the public hears things like, well, the Japanese and Korean automakers are practicing invoice pricing. They're just going to eat all the tariffs. Well, that's not true either. They're going to eat some, right? They want to retain market share. But make no mistake, those trade taxes, and that's what tariffs are, get passed along the supply chains and all the way through to consumers. I mean, the best example right now, Niqua, is those appliances I talked about, 1.9% increase in prices in June. That's very large. Think about what's going on globally. The price of washing machines, dryers, and dishwashers is falling globally. Why? Because Chinese overproduction. They're exporting their overproduction and deflation everywhere else in the world. Everywhere else in the world, the prices of those appliances are falling. But here, they're rising because there's an effective 48% tariff on all things from China entering the United States. Those things are going to be passed along. The best research from the tariffs that were small and only applied to China from the 2018-2020 experience was within 2 years, 90% of those price increases were passed along downstream, meaning the inflation that you see now is not the end game. It's going to be passed along. It will just take time.
Okay. So I want to switch to another big topic right now. And I'd like to do that by reading a quote from an op-ed you wrote in Barron's recently, which I found fantastic. So you said, should the immigration crackdown achieve its goal, and there is no reason to expect it won't, given the $168 billion Congress has proposed in its spending bills to step up enforcement, economists may soon be explaining to a stunned public how constraints on the labor supply raise prices. Put simply, having fewer workers pushes up wages. Higher wages increase inflation, and, most insidious of all, raise the expectation that elevated inflation will continue. Now, I found that really great piece of writing in itself.
Thank you.
Very enjoyable. But also, I want to put my finger on what I think is one of the sources of dissonance when I speak to people on both sides of this issue. And I think it's because when people imagine the immigrants that are the subject of ICE raids, they think of people who are less skilled, not considered to be as productive. And the immigrants that they imagine, or we imagine, as being truly useful to this powerhouse of the US economy are highly skilled. And in fact, the US has long created immigration policy around that sort of categorization of workers. So why should we lump together the chilling effects of ICE raids and bans on immigration by less skilled immigrants? Why should we lump that with inflation, with skilled labor supply? Can you parse that?
Let me give you an example. During the pandemic, when the Zs and younger millennials opted out of the workforce for a bit, we had a labor shortage. Workers immediately began to bid up wages, and the central bankers started to talk about second order wage push inflation concerns. That was part of the reason why interest rates went up as high as they did and as quickly as they did. In the labor supply data, during the June employment estimate, we saw the unemployment rate fall to 4.1% because, unfortunately, we're seeing people not show up for work. Why? Well, most of it's retirements, right? There's 11,000 baby boomers retire a day. We're just losing supply. And we should never discount that. That's not going to go away. That's structural. That's going to be with us for many years. And then we've got new policy, which is discouraging people who are at risk, who are now not showing up for work. Now, because Congress has fully funded the administration's policy, we should expect now the goal of 3,000 people per day, right, to be rounded up to increase. Now, when we talk about mass deportations, I'm talking about 1.5 to 2 million people removed from the labor supply. If you do that, even as the economy slows, the unemployment rate will drop. Less people on the job, your job security goes up, you shift and you turn to begin bidding up wages. The average worker thinks inflation's out of control when it's less than 2%. Imagine what they're going to think when it's somewhere between 3 and 4, right? Okay. There's an unfortunate conflation of Americans' perceptions around who immigrants are. If you ask them, most of them think they're the guys with the backpacks and the leaf blowers or the people who clean your house, but they're not. They're construction workers. We can't build homes quickly enough in this country. We're only building about 1.4 million on an annualized basis. We need to be building well over 2 million. How the hell are we going to do that without an immigrant workforce? Meat packing plants, manufacturing, agriculture, leisure and hospitality. We simply just do not have enough native-born workers here. We need more labor in the external sectors where you get that. And then there's the extraordinarily well-educated, productive workers who get degrees at our universities, right? And then bleed into the workforce and lift our living standard through their innovation, through their hard work, through their imagination, rounding up and removing labor supply from the economy. That has real consequences on the real economy. Should those numbers be much bigger than my 1.5 to 2 million? Oh, we'll be talking about second order inflation effects via the wage channel quite quickly.
My last question for you is more of another long-term look. Considering this wholesale policy change that's underway to pull funding from centers of research and data collection. You and I both know data is very much the beating heart of the US economy and the backbone of sound decision making and forecasting. Now, I think you're uniquely positioned in your role to speak to this. Do you think the US economy has evolved sufficiently to be able to step in and replace what I would consider semi-public goods? Can we privatize good quality data collection and research adequately? And would it be to our benefit to do that, especially in the dawn of AI kind of really taking hold?
The answer right now in the short to medium term is no. That the cost of setting that up simply are too large, and only governments can with the tax base can do that. It's going to result in a further bifurcation of the economy. You know, Anika, the upper 40% of households in the United States, basically all the households that make above 150 to 250,000, they're responsible for almost 2/3 of all spending. The other 60%, middle class, down market households, less than 40, right? If you see a real erosion in the quality of the data, let me tell you what's going to happen. I've got my Bloomberg terminal. I already have reams of alternative data to begin to rely on. I'll start purchasing data from satellite companies and other alternatives to make sure that my company has the best information to make hiring and portfolio allocative decision inside and outside the firm. I'm a privileged individual. I'm what Tom Friedman might call a super empowered individual, right? Life will go on, albeit not as efficient as it is now or was 10 years ago, but we'll make the adjustment. I'm hiring economists who are trained as data scientists who can manage AI. We're going to be fine, but you know who's not? Those 60% in the middle class and down market households. The ecosystems that have taken over economics, finance, politics, and policy will become worse. There'll be a detachment from reality. Arguments about where monetary and fiscal policy go will be untethered because they won't have access to the same data. And of course, under those conditions where we have to pay for this, it's not provided free by the public as a public good. You can imagine my reluctance to share it. Right? Yeah. So this is one of these situations over the medium to long term, I think, is that we're moving in a bad direction. Now we're going to need more data, not less. It needs to be quality and reliable. Because what you don't want to do is have a cat like me who has participated in the Bloomberg universe since 1993. And then Bloomberg begins to deliver its version of artificial intelligence based on its data. I will simply have a qualitative and quantitative advantage over those who don't have access to that data. And I'm really not sure that's the economy we want. I'm not sure those are the financial markets we want. So I want to make an impassioned plea to policymakers, central bankers, and the American public not to go down this path. It will not result in an optimal outcome, and it will only further intensify the inequality in the American economy.
Joe, I want to thank you for your time, for your candor, for your insights. This has been such an enjoyable conversation. Thank you for joining us on the podcast.
No problem. Thank you.